Hi, welcome to Market in a Minute. Man, we had another really hot weekend here in Denver. Before we start, here's a stat. It comes from a reliable source that 6,000 families in New York City pay roughly 48% of the taxes. And think about this. In Florida, they're going to eliminate the property tax. So that's the chatter next year. So, can you imagine how many people are going to leave New York City to move to Florida? Our biggest concern right now, not New York City, is Russia. So, Trump put a September 1st deadline. If for whatever reason Russia doesn't come to the table and agree to a ceasefire, I think that's going to be really bad for the overall market. And we think it's timely to shift to defensive growth. Not growth to value, but defensive growth. And we like Eli Lilly, and I'll walk you through that. So, stock market update. Trump is talking about a 100% tariff on those buyers of Russian oil. So, if Russia goes offline in terms of their ability to sell oil, oil's going to spike in a big way. We are in a seasonal period where oil starts to go down in September, but still it's going to have a big impact on oil prices. So here's September, and you can see how it kind of tops out generally around September, October. Hasn't followed this pattern, oil's been down nicely this year, but peaks out September, falls through February. So, even though, we have a seasonal pattern in front of us, we think that oil prices could go up significantly. And so if Russia doesn't come to the table by September 1st, we think having at least 3% of a portfolio in energy is very appropriate. That's about the market weight. So some of the economists are talking about the slowing in the economy, and the reason is because of final sales. And we saw final sales be really slow in the first quarter. And so, it slowed down in the first quarter. A slowing trend continued to occur. So if that continues to be, we see continuous slowing in final sales. You can see that here, how it's flattened out. That is definitely a negative for the economy. It sets up the Federal Reserve having to do something. They ought to get off the tariff part of it. There's not enough money supply being grown at this point for the tariffs to be an inflationary problem. At best a one-time price spike. So we think that come September, they're set up to cut rates and probably will do so through 2026. 4 to 6 rate cuts gets us down to around 3.5 to 3% on the federal funds rate. That's where it should be. So we can see that happening as we go through the year. That's really positive for the stock market. So what if Powell leaves? Who cares, right? If the market sells off on that, it's a buying opportunity. Powell has not done a good job. We need a new driver. So when during COVID, he increased the money supply way too much, and now he's being too restrictive because he doesn't want to make another mistake. We just need someone with some fresh eyes on the whole situation. Nothing against Powell, but he's not done a good job, and we need a replacement. In a falling rate environment, we think what happens is that other stocks really start to outperform. Instead of just NVIDIA and AI being big stocks, we think it could filter out to the rest of the stock market. Some stocks maybe having huge moves, and maybe even the cyclical stocks having really big moves as we go through 2026 with these rate cuts. So we're really bullish as we look out. We do see some issues in front of us. We have the seasonal trends of August, September. We're concerned about it. We see the Russian deadline of September 1st. So we think it's time to be a little bit more defensive, start to take profits. Now, one thing we're going to look at is what's going on with the bank earnings. The banks are the first to report. Banks have been good. The bank stocks have performed well. The earnings are good. If they sell off on these reports, we would take that as a barometer for the overall stock market. The semiconductor stocks, we like those, okay? If you look at technology, that's the area we want to focus on. We want to focus on the semiconductors that do have some AI exposure. A lot of companies do in indirect ways. But look at the semiconductors with that AI exposure, plus that'll benefit from a pickup in the cyclical side of the overall economy. So the semiconductor cyclical side has been under shipping now for quite a while. So as the market picks up for semiconductors, we think there's some catch-up demand in there in place. So as we go through September, October, or August, September, October, we're going to focus on those more cyclical areas of technology, and semiconductors is going to be our focal point. And as we look at defensive stocks versus momentum, NVIDIA, what a great stock's this been, right? So we've been making some good calls on when it gets too expensive that, hey, you want to be careful. It's too expensive again. It's $4 trillion market cap. It's now the largest market cap in the world. It surpassed Microsoft, and it's surpassed Apple as well, well-established companies. We think it's difficult to see that NVIDIA is going to outperform meaningfully from here. And it still may be an okay stock, but as we go further out, they're facing a lot of competition. Their largest customers are becoming competitors. So there's a lot of semiconductor companies that are trying to grab some of that market share. So we think it's appropriate, given the issues we see in the near term that are in front of us, to revert back to the defensive area of growth. So what is that? So defensive area of growth, probably the best candidate would be Lilly. And we put this NVIDIA versus Lilly here. So you can see Lilly's basically flat on the year, up maybe just a little bit, up 3%. And NVIDIA's up over 20%. So NVIDIA's performed very nicely versus the overall market, very nicely versus the defensive areas, well outperformed the tech group. So this is as an example. We can maybe see money flowing out of NVIDIA into Lilly. So why would it flow into Lilly? Well, Lilly's got a great pipeline, and they have a oral obesity drug they're going to announce data on here soon, phase 3. So it's coming before year end. I don't know the exact timing, but probably sooner rather than later. We saw the data on this with their indication for diabetes, an oral diabetes drug, and the data looked really good in terms of their weight loss for this drug. So we think pretty highly that this oral drug is going to look pretty good. Now, Lilly trades at roughly 29 times earnings. For a defensive growth stock, this looks pretty compelling. The drug group, or the healthcare group in particular, looks really attractive. So you're buying the best company in a really undervalued sector of the overall market. Now, this chart's from Goldman Sachs, so we appreciate that. You can see here that the healthcare group, the medium stock price, and the aggregate weighted as well, either method, that this group looks really attractive. Doesn't get much lower than this, right? 2010, 2020. It doesn't get much lower in this in terms of the valuation. So in the long term, we like the healthcare space quite a bit. The demographics are good. They've had some negative headlines regarding pricing. I really like the new FDA commissioner. Lilly's the best company and a really undervalued group that could have a nice pop. So if you ever have any questions, come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute as well. And so you can ping me anytime with questions. And just keep in mind, we want to be defensive going into the seasonally tough period. And I put a caveat on that. If Powell comes out and really explains his view of cutting rates 4 to 6 times over the next, say 12 to 18 months, I think the market's going to believe him, and it's going to have a big move. I find that highly unlikely to occur. So just look for some volatility as we enter August, September, but it's depending on what he says at his news conference later in the month of July. Take care.